Hello, my name is Anthony Cotton. I lead the Africa team at the Development Credit Authority, DCA, at USAID. At DCA, we know that access to finance is a major constraint for development in a variety of countries and a variety of sectors and for a variety of populations. And we know that if these organizations had access to finance, they would be able to expand their businesses, they'd be able to do developmentally relevant activity. We also know that banks around, all throughout developing countries have cash. They have a lot of liquidity, and they're not using it for productive purposes. They're investing it in treasury bills, or they're investing it in sectors that are very, very safe. They're investing it in multinational companies. They're investing it in import-export. They're investing it in extractive industries, and they're not always investing it in SMEs, particularly women SMEs. There's a variety of reasons that they don't do that. We know that the banks feel like the women-run SMEs are very risky. We know that they we know that these banks have other opportunity costs and transaction costs, and they also face a variety of regulatory issues that inhibit them from actually lending to that segment of the market. That said, there are a variety of tools that exist out there to encourage banks to be lending to these women-run SMEs to encourage their growth and to have a positive impact on development. DCA guarantees are one tool. At DCA, what we have is a credit guarantee, a partial credit guarantee that's backed by the U.S. government. And typically our structure is that we offer a bank 50% credit risk mitigation, meaning that if they lend to an organization that we deem to be developmentally relevant, or a certain sector or a certain segment of society, for example, women-run SMEs, we will allow them to lend their own money, and then in the case of a default, reimburse 50% of that default. So for example, if we, through a DCA guarantee, encourage a bank to lend, let's say, $10,000 to a woman-run SME, and for some reason that SME is not able to reimburse the full principal of the loan, let's say they can only pay back $6,000, DCA will come in and pay 50% of the default. So DCA will reimburse the bank $2,000 of the $4,000 default. This helps the banks, when they're making their underwriting decisions, be a little bit more lenient. It might help them reduce collateral requirements. It might help them improve the terms of the loan, including extending the loan tenor, potentially having an impact on pricing. And all these things can have incremental impacts on access to finance for our target sectors and segments. So we see DCA as one tool in a large toolbox to help encourage access to finance for our target sectors and segments, and we believe that that, along with a variety of other interventions, can actually help increase access to finance around the world. And our hope is that in places where access to finance is a binding constraint, it will actually lead to increased development outcomes.